As we look at 2026, what trends in capital markets should investors focus on first?
Focus on what changes cash flows, liquidity, and pricing power, the macro path, market structure and liquidity conditions, tech-driven information edges, and the policy and geopolitical regime. In 2026, the opportunity isn't a single trade, it's positioning for shifting risk premia and faster transmission of shocks. We'll translate each trend into what it means for portfolio construction, financing access, and the durability of returns.
What macro backdrop is most likely to drive returns and risk in 2026?
The central question is the path of inflation and policy rates versus growth. If disinflation continues, duration could matter again and credit may stay supported. If inflation reaccelerates, the market could reprice quickly and cash becomes valuable optionality. Watch fiscal deficits and refinancing walls, not just central bank headlines. Also watch labor productivity and energy dynamics, they can quietly reset earnings expectations across sectors.
How could market structure and liquidity shape volatility and opportunity in 2026?
Liquidity is increasingly episodic, calm most days, then gaps when everyone tries to exit together. Passive and rules-based strategies can amplify moves, while dealer balance sheets and margin dynamics can limit shock absorption. Private markets may keep assets off-screen until they reprice, then the adjustment can be abrupt. Investors should treat liquidity as a risk factor, size positions for the exit, not just the entry.
What technology and data shifts could matter most for investors in 2026?
The edge is moving from raw information to decision systems, AI-assisted research, faster testing of hypotheses, and smarter execution. Alternative data can improve timeliness, but governance matters. Bad data scales mistakes. Imagine a portfolio team using AI to monitor earnings drivers, supply chains, and sentiment in near real time, then translating that into tighter risk limits. The winners will pair speed with strong controls and repeatable processes.
Which regulatory and geopolitical risks could most influence capital markets in 2026?
Focus on 3 buckets: financial regulation affecting leverage and market access, industrial policy shaping winners and losers, and geopolitics influencing energy, supply chains, and sanctions risk. Fragmentation could mean higher regional dispersion and more sudden capital controls or compliance costs. Also, regulation around digital assets and AI could reshape market participation. Investors should price policy risk explicitly, diversify true exposures, and build playbooks for headline-driven gaps.
So what's the practical positioning framework investors should take into 2026?
Run a barbell, protect liquidity and downside while keeping exposure to durable growth. Build around quality cash flows, balance sheet resilience, and pricing power, then add selective cyclicals only where the risk premium compensates you. Treat hedges as budgeted insurance, not predictions. Demand transparency on manager process, data governance, and liquidity management. If you do those basics well, you can let 2026 volatility work for you rather than against you.